The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. If you miss an episode, you can always catch me on Spotify or on Apple, or visit me at themainstreetcode.com, or go to my website, and I have all the past episodes. You can hear me and relish the thoughts and celebrate the year for it. When we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors and clients across the United States. We're licensed in pretty much every state in the country. We are independent wholesalers of life insurance, annuities, disability, long-term care. So we help other agents find financial solutions for you. And we also work with lots of professionals to help you in your planning. And today I'm with a wonderful professional, Bobby Tollin. And how are you, Bobby?
I'm doing great. Thank you, Neil. Thank you for having me back again. This is awesome.
You're welcome. He's a recurring guest, and Bobby is a mortgage expert. And last time we spoke, we talked about maybe the younger generation buying their first house. And today I want to talk about seniors, because there's a lot of misunderstanding and not understanding of what assets you have. And the biggest problem people have after they retire is liquidity. Yep. And what do I mean by liquidity? I see so many people that come to me, and maybe they have a 401k, they have a house, maybe Social Security, and they're living off their income, and they have a house, and it's paid for, but that's it. So what happens is they run out of the ability to fix the house. So they let the house run down.
Right.
Or they have an event, like a long-term care event, where they need care, right, and they got to start spending money. And then the house could be lost. Or they might have 3 children, and they want to leave a legacy. They want to leave their house to their children.
Sure.
And we talk about this all the time, some of the problems. So some of the solutions now are with what they call reverse home equity loan. You tell me some of that.
So just a little background. I'm going to give myself a plug here. I'm a certified reverse mortgage professional.
Excellent.
Super proud of that designation.
Excellent.
There's maybe, don't quote me on the exact number, but last I asked was 210 mortgage professionals around the country that have this designation. And there are hundreds of thousands of loan officers, right? So, and so you have to have a certain amount of, 50 loans, I think it is, that you have to close in your name and sit for this exam. There's ethics and there's, education every year.
Sure.
So it's a big deal. I want to give a plug for the designation.
No, absolutely.
There's only a few people I know of in New York that have it.
Right.
So, so I'm a certified reverse mortgage professional. You were speaking about, someone going through a tough time, right? And they have a retirement, they have a free and clear home.
Not even if they're going through a tough time. Maybe they don't even understand that they're going to go through a tough time. Because listen, life is not an arrow. Right. We go through peaks and valleys personally. Our parents, our kids, everybody's up and down.
Right.
There's no straight arrow.
With regards to reverse mortgages, there's so much misconception around the program. And then they call it today a home equity conversion mortgage, HECM as an acronym.
I haven't heard that one.
Yeah, well, reverse the word reverse mortgage, it's like the joke, all right, the butt of the joke on the late night show all the time, right? You've had these actors on TV over the years pitching, speaking about the product, from Tom Selleck. I call him my younger brother, or my older brother. And you've had Robert Wagner back in the day, was the first one. He used to stand in the Hamptons in front of this mansion speaking about reverse mortgages.
Right.
I'll tell you a funny story off the air about that, about Robert Wagner. But, Henry Winkler of late, Pat Boone, and we can go on and on.
Yeah.
But a reverse mortgage really, it changes lives. Let me tell you how it changes lives. People stop, you had mentioned, people start worrying, they run out of living on retirement, they get, naturally, you got a budget, and you want to make sure you have enough money. The biggest fear is running out of money.
Absolutely.
Right? That's people's biggest fear, is to run out of money and then have to maybe rely on their children or ask their
You've been listening to my
money.
commercials.
I listen to a show or two, Neil.
Fear of outliving your money. It's number one.
So this provides you a line of credit, right, that you can use to help supplement your income. You got to use it responsibly. You got to be educated about the product. You got to sit down with a professional, preferably someone that has a CRMP designation, who does it, day in, day out, month in, month out, knows all the products that are available to you, and give you the options and educate you on the options, how the loan works, all the great that it's going to do, because that's going to enable you to start living your life again. People stop living their life, Neil.
See, what happens is the largest asset that people have many times is their house.
Yeah.
I think most times.
Yeah.
Unless you're, well-to-do and you're planned. But with most people, the largest asset's their house. And they don't realize that it's sitting with dollar bills all around them that they can't touch.
You know what? I'm gonna
They can't touch it.
Let me tell you about a loan.
You can't peel them off the wall. But you're surrounded by dollar bills, and you're worried about paying for your food, for God's sakes.
Right.
Yet you've got dollar bills. You can't pull them off the walls.
Listen, you probably hear more than I hear, because people probably scared to tell me why they don't like a reverse mortgage. What do you think the stereotypes are out there? What do you hear as a financial professional why they don't want to even look at the subject, approach the subject of a reverse mortgage?
Well, there's two reasons. One, many of the equity professionals won't allow their reps, anyone selling mutual funds, selling stocks and bonds,
right,
they won't allow them to talk about reverse mortgage. That's number one.
Do you know why?
Because they're so overregulated, in my opinion,
right,
that they don't want to go left or right.
Right.
They're so afraid of...
Yeah, they're afraid of litigation.
Right.
And there's always, as you know, in every industry, there's a few bad actors, right?
Of course.
And they may not have the best interest in the client, and they may advise the client the wrong way, and that stains the product for the whole industry.
10, 20 years ago, I'm going back a little bit of time, not a lot of bit of time, annuities were a bad word. Oh my God, annuities.
Right.
I love annuities. Annuities can provide you an income you can't outlive. Social Security is a freaking annuity. Your pension is a freaking annuity. I talk about that all the time because, you know what? There were articles in the journal. Annuities are bad. Annuities are bad. Annuities are great. It's a great tool. And reverse line gets rid of that stigma of, okay, I've now lost my house and it can't go to my kids.
Let me describe a loan product for you. Let me tell you about a loan. Let's say, here's a situation. You have a couple here in Long Island, house value, let's call it $700,000.
Right.
Okay. Early 60s, right? Let's say they can create a credit line, and it's not a high. You can't leverage a lot of money, percentage-wise. You're going to be capped out at like 30 to 40% in most cases against your appraised value as a starting point. And then, there's some built-in protections where unless you have a large lien that has to get paid off, you can only borrow up to 60% of what you qualify for. So let's say you're qualifying for, $250,000 against a $700,000 home, right? Or a little bit more. Let's call it $300,000. This way we got some zeros and we make it. So $300,000, you qualify as a line of credit. And that's got to naturally pay off any existing liens. But if you don't have any liens, and most people don't, you can only get 60% of that money in the first year. So they have a protection. They say, hey, you got to pay your taxes and insurances. You're only in your mid-60s. Today, the statistics, Neil, are if you're married, one person's into their 90s. So, and that's what's great about this program is you have the ability to pay. People don't realize that just because you do a reverse mortgage doesn't mean you just stop paying the mortgage. You can always make payments. This is a tool. Just like you have your bag of tools, this is a financial tool. For many people, they're looking at it now just like a traditional line of credit, but it gives much more flexibility and much more availability to the equity.
Well,
the line of credit's growing. Most people don't understand that line of credit, the unavailable, the funds you're not using, not only you not charge for, but that money's growing for you to use, kind of like an extension of a healthy credit card, right? So, but once you use it, it becomes part of the loan balance, but you're deferring the interest, and you decide whether you want to make a payment or not.
Listen, it's a tool, and unlike what we call a forward mortgage, you don't have to have the income requirements,
right?
Because you're retired, let's say, mostly. It's past age, so it's not more income driven; it's more collateral driven. Right? Am I using the right mortgage words?
That's
I don't
right.
want to confuse everybody.
Listen, but it goes back to credit. Today, when I was doing reverse mortgages back in 2007, 2008,
right.
If you had a pulse and the numbers worked, you qualified. Not the case today. You need to have good credit. You need to pay your bills on time. You need to pay your tax and insurances. You're not going to qualify for this.
So I'm going to go through some ideas for you right after the break because we're running out of commercial time, and it's going to be right around the corner. You're listening to the Main Street Code for Financial Success. You want to get a hold of me, Neil Himmelstein, 631-647-4694. Bobby?
I like to go by Bobby T, and I'm 516-652-8371 since 1995.
Fantastic. We'll be right back, folks. Welcome back to the Main Street Code for Financial Success. I'm here with Bobby Tollin. He is an expert in mortgages, both in whether you're new home buyer, whether you're buying another house, or you're a senior and you're considering doing different things. I know a lot of people that I work with, they want to buy another place in Florida, but they don't know whether they can sell their house and buy their house. I mean, It becomes very confusing.
Yeah,
maybe you have a solution for these people.
I do. And listen, it's not for everybody, right? But let me tell you about a product. All right, let's say you're looking to relocate.
I don't like product. How about solution?
Solution. I like that.
Thank you.
It's a loan solution.
Okay.
All right, and it's going to enable you.
I don't like borrowing money.
But it enables you to borrow.
Okay.
Right. So let's call it 30%. Right. So you're buying something in Florida for $500,000. Right.
Okay.
Cost of Florida. Now what it was, everything's up. So this would be a $150,000 loan, right? 30% of $500,000, and this $150,000. So now you get a loan for $150,000, but you're like, I don't want a mortgage. I don't want a payment. Right. You're retiring. Well, you don't have to make the payment. You can treat it like cash. So now you're putting down $350,000. Creates $150,000 of liquidity.
How am I doing that?
It's a reverse for purchase. People don't know that you can do a reverse mortgage to buy a new primary home.
So let's say I want to stay in my home but buy that extra property in Florida. Are they two primary homes?
No, you can only have one primary, so you have to decide where you're going to spend 181 days of the year. Well, it's where you spend most of your time. What do you consider? But your driver's license naturally should point to it. Your bank accounts, everything, your tax returns, everything should point to your primary residence, whether it's going to be staying in New York or Florida. But certainly we can solution, your legacy issues.
So I would borrow off my primary home, let's say here in New York, and use that money to purchase.
You can use depending upon.
Or am I borrowing the money?
Depends.
Off the Florida thing.
You can look at both situations. It depends. You can keep New York as your primary. If you have no lien against the home, you'll have access to more money. The catch is though, in New York, or not just New York, on the program, if you don't have a lien, they don't let you get into all the money that you're qualifying for in the first year.
Right.
And usually you want to make that transition. You want to be able to pull that money and buy in Florida. You're not going to be able to, unless you don't need that much money. Maybe if you only need a couple $100,000, but remember, you're getting, I don't know, let's say $700,000, you're qualifying for $300,000, so you're only going to get $200,000 in the first year, most likely, on a $700,000, average property.
So people that are in transition, and we're all in transition at some point, I have another situation too that's very interesting that you can do that. But let's say you just want to, a lot of seniors, they'll sell something and then buy something smaller because they want, but they cash out, but they don't need to cash out to buy something smaller necessarily. Maybe they can use this
Absolutely. It's a great way. Yeah. I tell all my financial planning professional colleagues that if you ever get a phone call to say liquidate X, stock or mutual fund where there's low cost basis, and there's going to create a capital gains issue and there's tax ramifications, why not take a look at a reverse for purchase? Get a loan for 30-40% against the purchase price. Give yourself the flexibility whether you want to make payments or not. It's really a wonderful product. I can't believe it hasn't. I can't believe it hasn't caught on, especially in this environment where we're so locked. Right, there's no inventory.
Right.
If realtors became educated, and part of why I'm here, Neil, is to hopefully someone tells a realtor, "Do you know about a reverse for purchase?"
That's interesting.
It's taking that cash buyer and showing them the option. The problem is realtors, they have a cash buyer, they don't want to foul anything up and talk about a reverse for purchase. They don't want to. It's not the right thing to do. You should give, especially the person that maybe has no children, right? No real legacy.
Right.
I've done loans where, where are you leaving this equity to one day? And, I hear their church or their temple. Sometimes it's like a cemetery or a charity. So my thing is, live your best life.
Right.
You don't you have all this home equity, right?
Right.
So you leave a little bit less to your niece, your nephew. I understand when it comes to children, but in most cases over the years.
But you don't have to. You know why? If you do it right and you borrow the money for a fraction of the cost, you replace it with something called life insurance.
Right.
So you can borrow this money, replace it with life insurance. Now, if you don't qualify, that's another thing.
Right.
Okay. But if you're healthy enough, and believe me, that's where we shine.
Yep.
But wait a minute. What's to protect you if you need long-term care? So now we have some new solutions that combine life insurance with long-term care all in one little package that we can combine with this line where no matter what happens, you can leave that value behind. And I've done this for 50 years or 30 years since I've been, not 50 years, but I've run into a lot of situations where typically it's been women because women outlive men, and they have a home, and that's their big asset, and they want to leave it to their kids.
Right.
Okay, and they have 3 kids. Sometimes it's 2 kids, but one kid wants to live in the home. One kid is an investment person. They live out of state. They're married. They got kids. They want to sell the home right away.
Right.
And the third one is very slick. They want to rent it out and take the income. Well, the problem is, if they can't agree, what happens? They sell it. Okay, let's sell it and split it. Well, the worst time to sell and split a house is when you have to.
That's right.
Even if you're very successful and very wealthy and you own buildings and rental houses and you have to liquidate them to pay taxes or for whatever reason, the worst time to sell is?
When you have to.
When you have to. So, one of my solutions that I worked on years ago, and now it's even easier with today's products, is to take some of the liquidity, take some of those dollars off the wall, reallocate them so that it's not lost. If I need long-term care, I've got a policy that's going to cover that.
Right.
So I don't have to drain my savings or anything else. I got the golden ticket here is going to cover that. And if I should never need it and I happen to pass away, instead of dividing that $500,000 house, I'm dividing a $500,000 check, which is much easier to distribute, and I could still leave the house.
Right.
Necessary. If it has a mortgage, one can pay it off, one could do whatever. So,
yeah, you had a plan. It's planning.
Yeah. Let's talk about the other misconceptions.
I wish I would have met you decades ago because, my mom is, a perfect example of not doing this planning. And, all my dad's hard work over those years, it's all going to her care, in memory care. She can, with Alzheimer's. And then, it's hundreds of thousands of dollars a year. Yeah. It's over $100,000 a year to care for someone.
It's
so
terrible.
No long-term care. It's private pay until then you have to go, medicate until you run out of all your money. But it's not how you want to plan.
Terrible system if you don't plan. So, I was going to talk about another situation. It just kind of left me for a second. But leaving cash behind is a much better thing to divide amongst people or children or businesses than leaving a house or a building.
Right.
It's liquidity is key. Liquidity is key while you're living. Liquidity is key. Now, we didn't talk about this, but we could probably talk a whole show about this. A couple of weeks ago, I talked about sequence of returns.
Yeah.
And people don't understand that everything's great. They saved all their money, and it's all, let's say, in a 401k or an IRA.
Right.
Okay? And this is their source of income, plus Social Security. And the problem is every dollar they touch is taxable. Well, all of a sudden, you hit a market, and you get a bad year.
That's right.
You get a bad return. So I might still need that money, and I have to drain my 401k. Now, I advocate on doing life insurance and Roth IRAs and tax-free planning, but a reverse can kind of do the same kind of thing, right?
I'm most passionate. In fact, I just spoke at the Long Island Tax Symposium in November on this subject matter. And it's incredible.
It's another tool. It's another tool in the toolbox.
It's like life. It's like you if you have a family, right? That's when you usually get life insurance, right? Oh, I've got children, I'm gonna get life insurance. But you have a portfolio worth $1 million today, or whatever, $750,000, $500,000, and you want to retire. You know, it's 65, 68, 70, 62. Whenever you're retiring, what happens if that portfolio takes a